Well, good evening. Welcome. Thank you for coming across town today. I'm not quite sure how to describe the weather. I traditionally start my economics lectures with a discussion on the weather. Today I've had everything. Rain. Did I have sleet? I'm not sure what we had. Wind, we certainly had. Sun, we certainly had. And it's humid. So very hard to dress at this time of year. But I'm here, and thank you for coming along. This year's lecture series is going to be given to you within shadow of two events that have cast their shadow over this country and certainly over this lecture series. The first event is the global financial crisis that towards the end of this lecture series will be coming up to the 10th anniversary of its start in August 2017. And the other event that casts a shadow over all of us is slightly more recent, the referendum, the 23rd of June this year. In fact, I gave a lecture here just before that referendum outlining some of the risks we would be taking were we to vote to leave the European Union. The risks are still there, and I suggest you might want to look at that lecture, because I think most of what I said still stands true. The two events may be described as either an earthquake and or a volcano, but just like earthquakes and volcanoes, I hope to show in this series, they're not unconnected events. I think the two have related causes. I'm not going to tell you all about the causes today. What I'm going to try and do today is set a scene, I think, set a scene in terms of business cycles, business cycle fluctuations, and recessions, and how the economy, or when the economy typically recovers from recessions. And we are very lucky in some respects in the UK is that we have a massive historical data from which we can examine what happened in the past. And of course, as all good investment advisors will tell you, and I'm not an investment advisor, the past is no guide to the present, and that's certainly the case when we start to think of the most recent recession that arguably we're still living through. The past was not a very good guide at all to that present in which we now occupy. So let's start with a quote from one of my favourite authors, Italo Calvino, Mr. Palomar. He says, and this is of course William Weaver's translation, a person's life consists of a collection of events, the last of which could also change the meaning of the whole, not because it counts more than the previous ones, because once they are included in a life, events are arranged in an order that is not chronological, but rather corresponds to an inner architecture. So we could, if we remove the word life and put in the words economic growth of a nation, we may have a nation which has grown at 2 to 3% over a couple of centuries, which has delivered the first industrial nation, the richest nation, and continues to be a nation right at the top of the income distribution in the world. But we may have had a sequence of unfortunate events in the last decade or so that may make us feel that we're moving behind the pack, that we're on an inexorable trend where we're going to be relatively poorer compared to the rest of the world than we have been either from our received wisdom or the conventional wisdom would suggest we ought to have. And this may mean that the whole story then starts to look bad. There's all kinds of cracks in the economy, things we haven't done, things that we need to address. The political economy needs to think very hard about. And I think what Italo Calvino wrote about a person's life is very much true when we try to understand the evolution of an economy over the very long run. And I shall try an event, in fact, to try and tell you something of that story this evening. Mostly through charts and numbers, perhaps a few stories, and almost certainly no jokes. So what do we mean by a business cycle? I covered some aspects of what a business cycle was in a lecture in last year's series when I was thinking about the costs of a business cycle. How do we think about the costs of a business cycle in terms of unemployment or what it does to consumption? I'm not going to talk too much about costs today. I'm just going to talk about business cycles and recessions and how we recover from them. So I refer you to the answer I gave some lectures ago if you want to know about the costs of a business cycle. But let's think what a stylized depiction of the economy. A stylized depiction of the economy is something that tends to grow on some kind of trend. Where does the trend come from? Well, economists haven't got a very good answer. They say it's exogenous. That means it comes from outside the system. and it is driven by something that's magical and called productivity, or total factor productivity. And many economists have built up careers trying to understand what drives productivity. In fact, many of my colleagues at the Institute work very much on this area, giving us ideas as to where productivity has come from, where we might find it now that we have lost it. All kinds of questions that may start to emerge once we start to think about it. And as everyone kind of says, once you start thinking about macroeconomics, there's very little to think about beyond productivity. It's the answer to so many of our problems. But let us suppose there is a trend in the economy, and let us suppose the trend is mostly driven by accruals of productivity. And for those of you who, at the end of a long day, are sort of thinking, what the heck is productivity? Essentially, it's the difference between inputs and outputs. If I have a system in which I have inputs, and I'm combining capital and labour, the amount of outputs are adding in the amount of productivity. So how much I can get out of those inputs per unit of input gives me the measure of productivity. And so it's kind of telling you what the value added is compared to the quantity of inputs I put into a system. And the fact it's an upward trend tells us that over time we learn how to do things better. We learn to work smarter or in a way that leads to productivity gains. Now you'll see there I've put error band about the trend, because even if we go back in time, we don't really know the level of trend. Let me be honest with you. An honest economist mostly will tell you that we don't know the real level of trend. And as we go from left to right, we're heading towards the present. I've made the trend, the errors around the trend even wider. Because as I think about now, I know even less about now than I did the past. Because right now, we know even less about what's going on because we've got less of the recent set of events to try and understand what's going on, less of the data, the surveys that the Office of National Statistics carry out to understand where the economy is, run through a number of preliminary surveys that keep getting updated for a number of years until we get final estimates. And even then, every decade or so, they get revised. So the trend is highly uncertain, I'm afraid. And as sensible people, we have to accept when we don't know the answers. We have to deal with the fact it's uncertain. Now, the blue line is the actual level of the economy. So the economy may grow fast, and that's where the blue line is steeper than trend. That's an expansion period. Or if we get towards the peak, we might even call it a boom. Expansion when the economy is growing faster than trend. And there may be periods when the economy grows more slowly than trend, and we may call that a contraction. And you'll immediately note that when people talk about business cycles, what they're really talking about is the deviation of the current level of the economy from the trend. And if the blue line is above the trend, we're in a positive phase of the business cycle, and if the blue line is below the trend, we're in a recessionary or contractionary phase, and if that persists for a long time, we may wish to call that a depression. And the key thing to think about, and I want to carry this thought through this lecture, is are these what economists call perturbations, these blue draws from around the central distribution? Think of the trend as a central distribution on a point, and think of the blue lines as draws from either side. And you could have random draws, or you can have draws that, once they're in a particular direction, they tend to stay there. In the language of economists, they're persistent. And clearly, I'm going to see if this pointer works. Of course, everything at Gresham College always works, and this works. Here, when we look at the trough, what we're seeing there are persistently negative draws, in the sense in which it doesn't begin to look normal anymore. If these were truly random, get on with your life. Forget about it. It doesn't matter. There's a random boom, a random recession. They'll even each other out. On average, we live forever. It doesn't really matter, is one economist's answer. Of course, another economist would say, in the long run, we're actually all dead. So these perturbations or fluctuations may matter. But they will particularly matter, and this is my key point today, is if they're persistent, because then they won't necessarily average out to the trend, and they may require different forms of policy. Indeed, a recession or a depression may be a signal to the body politic to reform, to think that the things we have done in the past are no longer the way we should continue to do them. And that's true if you start to think about the manufacturing recession induced by the exchange rate appreciation in the early 1980s, or the recession associated with entry in the ERM in the 1990s, or the recession through which we've just lived and arguably are still bearing the consequences of. Has that recession been a signal to reform either the financial sector, fiscal policy, or monetary policy, or regional policy, or house price, or the housing market? A whole bunch of things that maybe this is a signal for us to reform. And I put that as a question to you. I won't give you the answer today. I'd encourage you to come to my lectures over the course of this year. But again, whether this is random or persistent is the key question. If it's random, it may not be a problem for us. Just have to sort of live with a random draw. So I go back to my point about being very lucky in the UK that we can look at what's happened in business cycles for a very long time into the past. And some very well-known American economists in the mid-20th century studied the period 1790 to 1850. Geo, Roster, and Anna Schwartz, who was Milton Friedman's co-author on his great monetary history. But before she worked on that, Anna Schwartz worked on an index of business cycle activity, which I think is available monthly. I'm kind of going through the microfiche in my idle moments at the Institute, trying to understand whether I can get a monthly version of the series. Such is the excitement I live my life under. And there's a few things you can see when you look at the data. They construct an index of business activity. Let me tell you the elements that make up that index. Is Hoffman's, it's not the Tales of Hoffman in this case, but it's Hoffman's Index of Total Production, which is something constructed by an economic historian. Kondratiev's Index of Textile Production, the number of bankruptcies, which our law courts are happy to provide, going back in time. This gives us a measure of the business cycle. The value of inland bills of exchange traded. A share price index, constructed initially by Friedrich Hayek in the London School of Economics in the first half of the 20th century. The volume of domestic exports. The percentage of iron foundries that are unemployed. This country had iron foundries everywhere, and they were able to measure the percentage of them which were not being used, and that went into the index. And finally, and perhaps of course, brick production. So these indices were weighted and gave them a measure of index of business activity, which is ultimately used to derive measures of gross national product, gross domestic product, at a lower frequency in this period. So what do you observe? Well, we observe, I think, the kind of trend I was just describing. The economy tends to be growing over time at a given rate, and you could estimate the slope of that, and that would give you the growth rate of the economy. But clearly around that trend, there are persistent fluctuations, and I could estimate a trend line, or indeed what Geo, Roster and Schwartz did was to construct what they've called an abstract scale. So for every year, qualitatively rather than quantitatively, they looked at all these data points and they decided whether the country was at zero, which was a deep depression, or at the top of the scale, at the peak of a business cycle. So 5, think Lawson boom, and 0, think Lehman's collapse. And then you can have some idea of what they had in mind. And the interesting thing is you're seeing business cycle phenomenon. We're seeing 3, 4, 5, 6, 7 peaks, which implies around 6 peak-to-peak business cycles in this 60-year period. And a similar number of troughs, and a similar number of trough-to-troughs in this period, full business cycles. So the notion of a business cycle is not new, its measurement is not new, and the fact that the notion is not new and the measurement is not new leads to some views as to what we'd expect a business cycle fluctuation to be. If we're going to crank forward our expectations of what we think the economy is going to look like year to year, we're going to have some notion of what it's looked like in the past to guide us. It's not always going to be right, but that's essentially what the statistical techniques are going to be using. Let me summarise where we are. So Geo, Roster, Schwartz constructed a business cycle activity index. It shows the trend which occupied, which occurred during the 1790s canal mania, the wars, Revolutionary and Napoleonic Wars from 1792 all the way through to 1815 with Waterloo, the post-war deflation, and the return to price-time stability. The cycle they estimated is a deviation from trend, and as I've said, the abstract index is a measure of the depth, or what economists call the amplitude of the business cycle, how deep each business cycle was. We can see that there were 7 peaks and 11 troughs, so around 6 to 8 business cycles of 6 to 10 years duration. So if you want to go from peak to peak, which includes one recession and one boom, we might have thought they're going to last around 6 to 10 years. That would be the normal length of a business cycle. And that matters because we may think that over that period, the economy, if it's going from peak to peak, has got to full capacity. There's been a recession, and it's built itself all the way up again to use up all that full capacity. It's one way of thinking about how the economy regulates itself. And if you think the economy is near full capacity, that will help you think about the kind of policies you might want to implement in that economy. If we're far below full capacity, you may think there are policies you have to implement to increase the level of demand in the economy. If you think we're near full capacity, they may not be the kind of policies you wish to adopt. Let me move on. So, using higher frequency data, we can also look at, and I'll just take a sip of water, business cycle activity, and here we're in months rather than years, to make that absolutely clear, of peak to peak or trough to trough business cycles. And you can see, if we take the kind of long period from 1871 through to 1997, that the peak-to-peak business cycle looks like it's of the order of around 5 years on average. Peacetime cycles look ever so, the peacetime cycles prior to World War I look ever so slightly longer, nudging towards nearly 7 years. Peacetime cycles in the interwar period look relatively short. Remember, you've got the return to the gold standard and the various shocks associated with the Great Slump in the early 1920s and the spillovers from the US Great Depression in the UK. So relatively shorter cycles in the interwar period, and somewhere between the two in terms of the average length of peacetime cycles in the post-war period up to the last 20 years, which I've excluded for reasons you'll see in a minute. So again, people are saying to themselves, how long can we expect a business cycle to be? And the answer seems to be, well, around 5 years. I've put in standard errors, and we can see there of around 24 months, which means 2 years. So that means we can take off 5 years and add or take away 2 years, so we get something like 3 to 7 years is what your sensible expectation should be of a business cycle fluctuation. Looking at the data. Is this going to go on? It is. So just to summarise where we are from that set of observations, is that if we look at the business cycles from the late 19th century to the late 20th century, we get 5 to 6 years from peak to peak or trough to trough. The pre-1913 cycles seemed a little bit longer, that's around 7 years. The post-World War II cycles seem to be around 5 years, relatively short. The standard error, so the extent to which we're not fully certain, is around 2 years around that. So if we add that to the averages, we get cycles to operate in the range of 2 to 8 years. So economists took that as a way of calibrating their filters. A lot of people spend their careers, as well as thinking about total factor productivities, there's a bunch of people thinking about total factor productivity, there's a bunch of people thinking about how to measure business cycles. And the way that they measure business cycles is to use forms of statistical filter. And the filters are ways of extracting the trend that I showed you a minute ago and working out what the cycle is. It turns out there are an infinite number of ways of decomposing series. So many economists in many departments throughout the world think very hard about these questions. See, that's almost as interesting as looking at monthly microfiche at the Institute. There's things that we do that we can't share generally in public, but that's what we do. And so the guidance, when we looked at the length of business cycles, and as time goes on, it's not only the UK you can look at other countries as well, French data, starts to come on stream in the 20th century, US data particularly as well, led us to the view very often that business cycles tended to operate in the range of 8 to 32 quarters. So a couple of years out to 8 years. So by which time you could have expected the business cycle to have exhausted itself. So just hold that as a thought, and I'll just remind you of what a business cycle is in demand and supply space. And this is all something that is incredibly simple. But think of this AS curve as aggregate supply. Think of this as the trend that I showed you a minute ago. It's that trend that was going up from left to right. Let's suppose at every moment in time that trend corresponds to this vertical line. Because it tells you at any moment in time what's the capacity of the economy. It doesn't matter what the price level is, that's the P here. It tells you at any moment in time there's a given level of capacity in the economy at that price level. And if the market clears, this is simply saying that, well, if for a given think of this as a given level of income that you've got, money income, if prices are lower, your effective demand is higher. So the quantity of goods that you can buy with a given level of income goes up if the price level is lower. So it simply is a schedule for aggregate demand that's downward sloping. So the two, where they cross, will give you the level of output at any moment in time at a given price level. Simple market clearing condition for an aggregate economy. There's a lot of complexity in there. We can boil it down to something very simple. The trend are these movements in the AS curve over time, moving to the right, as we get better in terms of doing things, and productivity accrues in the economy. That's all that does. But let's take it as a stationary moment and momentarily stop the trend. So let's remove that, and now just think about the economy responding to a demand shock. So this could be demand could increase because confidence is high. Demand could increase because uncertainty falls. Demand could increase because interest rates have fallen, so people bring forward investment. Or interest rates have fallen and people start to borrow more and consume more. There's a whole range of things that might lead to demand increasing. The government may decide to spend more money and inject demand into the economy. Even the exchange rate may fall. I'm sure that would never happen. That might bid in... That was the one joke. Just the one. The exchange rate might fall, and that might bid up demand for domestic goods. So then that would lead to a shift out in the demand curve. All the things I've said could go the other way, and then the demand curve could shift in. Now, the demand curve shifts out, and prices were completely flexible, then all that would happen is the economy would sit on the same supply function and you'd have higher prices. But in the short run, prices may be inflexible, they may be rigid. People may not understand the nature of the shock. They may not be completely aware about what the appropriate price level is, so there may be a period of learning. This may mean, for a very short period, the economy may be able to produce more than its full capacity because prices haven't fully risen to reflect the market clearing condition here. So you may get a business cycle peak as demand increases. Analogously, reverse the problem. If there's a negative demand shock, let us suppose the British people voted to leave a long-established trading area with another part of the world. I can't imagine that would ever happen, but let's suppose we did. And as a result, all those trading relations became uncertain or more costly or were potentially broken, and as a result, demand fell in the economy. Of course, that would never happen because there'd be a boom in those circumstances, wouldn't there? But let us suppose that did happen, and there was a negative negative shock to demand. And the word shock is important. These are unanticipated shifts in the demand, and I'll come back to unanticipated in a minute. They're surprises. We'll find out in a minute that recessions are surprises. They're not things we expect, like the Spanish Inquisition. Almost a joke, but not quite. Okay. So trend here, it's not trend, this is a trough. So with a negative shock, if prices adjust downward slowly, we get a trough. And so this period is recessionary, and this period is like a boom. And of course, this period, prices are rising, quantity is rising, growth is above trend, and here prices are falling, quantities are falling, and growth is below trend. So it's telling you that one possible explanation of business cycle fluctuations are that list of demand shocks that I just outlined. Now, another set of possibilities is that there could be temporary shifts in supply. But I'll leave that as an exercise for you to do at home. And if you can send in your answers, I'll have them marked by the time of the next lecture. Or I'll get a PhD student to mark them, which I believe is what normally happens at universities. So we have some idea of a demand-led business cycle. And if I go back to my point from some moments ago, if it is a demand-led business cycle, I might want to treat this as random. If there's a well-established demand function here, then if it's stochastic, if it's not determined once and for all, there could be all kinds of shocks, weather shocks, referenda shocks, change of prime minister shocks that lead to temporary movements in demand that you think are going to reverse themselves, so why do you have to do anything about them? That's one possibility, one response if we think it's random. What if it's not one? What if it's something worse? Now, one way to think about this is I would have heard of expressions like liquidity traps, or heard of expressions such as debt deflations, or you may have even heard of expressions such as balance sheet recessions. All kind of boil down to similar things of a multiplier, where once we get into a trough, and I'll explain the mechanism in a minute, we continue further downwards into a depression. And that's just like my line from a minute ago when we went below trend and we stayed there for a heck of a time. That's a depression. There's all kinds of reasons why that may happen. And one way to think about this most simply is debt. Let's suppose we have a certain amount of debt in the economy. Let's suppose it's defined in nominal terms. And let's suppose it's £100 of debt. Okay? £100. Massive amount of debt we've got. And that's the amount of debt we've taken on when the economy was at full employment. Now, nominal income in the economy, the amount of goods and services we can buy in nominal terms, is given by P times Q. The quantity of goods times the price gives me nominal income. Debt to nominal income may be something that drives the persistence of this shock. So let's go the arithmetic here. I've gone from this point here to this point here. It's clear at T, it must be the case that PQ is less here than it was here. The area is smaller. PQ is simply the area. So if PQ is smaller, the denominator of debt to income has fallen. The overall debt to income ratio has increased, even though the level of debt is still at £100. Even if the level of debt is cheap to service because interest rates have fallen. The level of debt is now higher relative to income than it was in the past. That might mean that we're all saying to ourselves, oh gosh, okay, debt is £100, but my income has gone to £50, my debt to income ratio has gone to 200% instead of being 100%, I need to save more because I want to pay off my debt. I don't want to not pay off my debt. I don't want to be a bankrupt. I don't want to ruin my reputation. That would be the last thing I want to do, what you might think. So if I save even more and I take more demand out of the economy may move down to this point here, where debt to income is now even higher, and the economy may respond with a further round of saving. Now, you might try to offset that a little bit if you're a policymaker. You may say, well, as a fiscal policymaker, I'll try and inject some demand into the economy to get it back to here. As a monetary policymaker, I may want to cut interest rates so at least debt service is not as large as it was before, but the mechanism is still there, driving down consumption, or keeping confidence back, or increasing uncertainty because the level of debt to income is high, and that's making people worry about its sustainability. And that applies whether it's the private balance sheet or the public balance sheet. It's not just a private phenomenon. We've got to worry about this in both dimensions. So this might be the kind of mechanism that's holding an economy in a depression rather than returning. And if it's holding in a depression, it doesn't become random anymore. We get stuck there. It becomes persistent. So it becomes a change of regime, something we have to think about, something that signals to us we've got to do something. The economy's in trouble. So please keep those observations at the back of your mind. And now I'm going to go on to the period beyond what we thought the economy looked like. So by the mid-90s, we had a view. Maybe these demand-supply shocks came along. They were mostly random. Monetary and fiscal policy could stabilize events. We hadn't particularly got to worry about elongated business cycles or very deep recessions, because we kind of thought they're things that we'd worked out how to sort out. That may be a little bit simplistic, but it's probably not far away from the kind of lecture you might have had delivered to you 20 years ago. There was a famous person who said, we got to the end of boom and bust, but I can't remember his name. Someone can remind me afterwards who that was. Now, let's have a look at the most recent period. What I've done here is I've taken quarterly growth rates in GDP. So just taking quarter to quarter, and this is the percentage quarterly growth rate. So I haven't multiplied it by 4 to annualize it. This is just the quarterly growth rate. And I'm trying to say, look, this is the data gets revised. Now let's see if we can pick the troughs and the peaks of the business cycle. Let's see, having told you what I think the business cycle looks like, as an economist, let's take it and look out of sample to see whether the business cycle that happened after that looks anything like the one I've just described. That's the thought experiment we're now going to do, or undertake. So let's have a look at a few things. There's a trough here in 1990, and there is a trough again in 2008. 18 years between the two. I've just spent half an hour telling you they're always about 8 years. And this is the very next one, after having done all that work. Can I say bleeding egg? I didn't say bleeding egg. It's just about on the edge, isn't it? So after all that work, bleeding egg, the next one is 18 years long. Completely outside of what people might have thought was possible. And so we've termed it increasingly the long expansion in growth. Economists are sort of very imaginative in their use of titles. We could have said the great expansion, but I didn't like that. So we've gone for the long expansion in growth. Something that just went on and on, and I think Australia is still in the middle of a long expansion. And when we look at growth rates, it's relatively easy after the fact to pick the troughs. And that kind of matters, because if we're in a trough, we might want to respond. So at that point, we know there's spare capacity. So as a policymaker, you think, I have to do something now. I'm not just going to let this happen. Because the trough is relatively easy to identify. Now, what you might say then is, if I can identify the trough, why can't I identify the peak? Because the thing that follows a peak is a trough. So if I could identify I'm at a peak, maybe I could do something about it so I don't end up with a trough. Do you see the reasoning? I'm not sure I do anymore. But anyway, I think that's the basic argument. But can you identify a peak? Well, turns out, nearly 30 years on, yes, I can just about see the Lawson peak, the Lawson boom. It was incredible. Quarter-on-quarter growth of over 2%. Some of the largest numbers ever seen, certainly in the UK. And of course, after the fact, you can see it was a peak because growth fell, but this number itself is incredibly high on quarterly growth. Now, if I use that as my frame of reference, if I wanted to understand when the economy was at full capacity, so that I would think about raising interest rates so I don't get an inflation boom either in prices or in assets, I'd want to be picking the peak if I were thinking in a business cycle way. But even here, 1997, 20 years after the fact, I'm not sure which one of these three is the peak in that business cycle. Because what I can't do with slides these days is sort of cover half of it and allow you to choose. But we need to imagine that you're living 20 years ago and deciding, is this now the peak? Because that's the data observation you have. You might have thought it was the peak because it looks higher than what you've seen here. And maybe you might have said spare capacity is all gone. I have to start putting up interest rates. This is the problem monetary policymakers have. But possibly it wasn't the peak because we didn't have a trough after it. So maybe the peak was in 2005. Maybe we should have done something more there. I don't know. I'm not saying we should have. I'm just saying it's very hard to pick a peak in real time. And that's 10 years ago. Or was it in 2006, just before the enormous collapse we see there? And we have the same problem today. If we look at 2012-13, was that a peak? 5 or 6 years after the depth of the financial crisis. Certainly if we were using 20th and 19th century reasoning, we might start to think 5 or 6 years into a business cycle, we're getting back towards the peak. But maybe that thinking is out of date. Maybe we're living in different times. Now, I can integrate those growth rates and instead look at levels. So this is just the same data with the level of GDP rather than its difference, the growth rate. And here we can see, this is in constant prices 2013, millions of pounds. And here we can see the same Lawson boom at around this point. That's the derivative is highest here, so we can see where it is. We can then see the recession, the negative growth rates as this heads down here. And then we can see the start of the long expansion, all these positive numbers year after year, with what looks like the peak in around 2006. And in terms of setting policy, how you're going to think about that is almost entirely determined by what you think the trend is. Because that line I've drawn there, I could pretend, is the result of some complicated statistical estimate that I've used after many years of econometric study, asking all kinds of important fellows of the Econometric Society or the British Academy what their view is. In fact, I just drew it. And I drew it in such a way just to show you on an arbitrary basis I could draw this line and suddenly make the case that there was a massive boom here. Why was nothing done? If I wanted to. I'm not saying I should. But you can almost choose the trend that you want to make the argument that you want to make, which might be there was a large boom here, the government should have done something. Alternatively, I could have drawn a steeper version of this line that followed this trend here. Then the line would be up here. There'd be a massive gap or spare capacity in the economy. And then I'd be arguing for expansionary fiscal policy, even lower interest rates, and something must be done at an important level because the economy's 10 or 15% below where it is. In a sense, I'm drawing the trend to drive the policy that I want to see in place. I'm not saying anything is right. I'm saying just beware. Because the trend is actually your friend if you've got a policy in mind. So, it's an 18-year trough to trough cycle in this long expansion. Why is that? Were there different economic processes? Or was it just a juxtaposition of many different factors? Was policy egging on the cycle in a longer way? Was globalization helping the cycle happen more because instead of there being an inflation, ever cheaper imported manufactured goods was stopping that inflation from taking off? Was there a change in economic structure? Were we managing inventories better? Was the digital economy something that leads to differences in the economic cycle? Or was it that globalization shared economic risks so that when shocks came along, they were shared across the world so we didn't get a particular downturn in this country? We don't know the answers. These are all possible. Clearly difficult to know in real time what is a peak, but your view of trend or the trend determines the fiscal or monetary space that is available to you. So I want to go back a little bit and rehearse the argument that recessions are unpredictable. And for this, I'm not in any way inclined to beat up on the Bank of England. I'm just using this as an example of just how difficult it is. And this is from the November 2007 Bank of England GDP projection. You'll be familiar with these kinds of charts. All the bank does is it shows the ONS, Office of National Statistics, measure of year-on-year GDP growth, plus an error band of the type that I showed in my very first chart, because we don't know the past accurately. It's a lot of surveys. And then using their model, which is they're able to then project output growth and a fan chart that encompasses a 95 percentile of possible growth outcomes. So with 95% percentile, the view was that growth at the end of 2007 on an annualized basis was just over 3%, and that with 95% certainty, over the next 2 years, it was going to be somewhere between 0.5% and 5%. And this was a model using the data and using the errors of the kind of period that I've been describing. Because you're then using the errors or the statistical draws you've got to drive your view of where the economy will be in a few years' time. Right, so just remember that black line and remember the range 0.5 to 5%. What happened? Let me tell you. So the first thing, where we thought the economy was leading up to 2007 at the time is the blue line. Where we now think it is, given the changes in data, the estimates, the final measurements that have come in, we now see the 2014 vintage as showing something more of a peak in 2005 than we thought at the time. That's quite a large difference. But more of a fall, an early sign possibly of what was about to go on in 2006. But the kind of errors talked about here are certainly, I'm just going to flip back in the slide, are certainly within the bounds of the errors shown there. So we're aware of errors and we know that we can't measure now perfectly. There's error attached to it. The average of the central point of the bank's forecast is this purple line here. We can see the economy falls a little bit and essentially goes to trend of around 2%. You'll recall the range, the 95%, what they thought was almost certainly going to be within the range of output growth, essentially around from here to here, the top of the box. The red line is, of course, what actually happened. I'm not saying the bank should have forecast a recession. I'm saying that it's very hard to forecast recession because they're unanticipated events. And when they happen, they tell you that something, almost obviously, is terribly wrong and we need to think about how to address it. That's what we see from the numbers here. Let me cut the data in the UK in a slightly different way. What I've done here is just produced a histogram. Bars in range, so these are the growth rates in the post-war period with the zero handle, 1 point something, 2 point something, 3, these annual growth rates, and the frequency of the observation. So we can see that 2 point something growth happened in around 11 years in the post-war period. So we've simply taken the growth rate in every year and assigned it to one of these bins and then counted the number of times it occurred. Just wanted to understand the frequency domain for output growth. And what, is that a question? Oh no, someone outside. And so what I want to ask myself is this normal? Does this correspond to the view that fluctuations around the trend are random? Or is there something else that goes on at the extremes? And by eyeballing it, you may say, that doesn't look terrible. We know what normal Bell distribution looks like. You may say, that doesn't look terribly normal to us. It looks abnormal. Is there something odd going on? And you're all smart enough to see that this is the thing that looks very interesting. It looks like, remember, a recession is a contraction in growth, so it's 0 or less. It's almost like it's uniform here. Once we're in this range, we're equally likely almost to have growth of -4% as we are 1%. If it was normal, -4% would be much less likely than -1% as you go further away. But the distribution doesn't seem to look like that. So what I can do is I can generate, this is the red bars here, a hypothetical normal. And I can say, if it were normal, given the mean of the distribution and standard error, what would I expect these bins to look like? And that's these red lines here. This is a normal distribution. And what we can see is that we see many more observations at 3% and many fewer observations at 1% and many more observations in the 1 to 4% range than we would expect if this was a normal distribution. It goes back to the point I've been making. It looks like recessions, and you think, I might have come a long way for a very short cut here, are not normal. They're things that are outside normality, things that trigger or suggest a change in regime and require a change in policy. And the statistics seem to suggest that, because we can see that if we compare this frequency chart to a normal, it fails. You can run a statistical test, a chi-squared, and you can see that it fails, but I'm doing it here casually just to illustrate the point. And we can go further with some simple calculations of probabilities. And then there'll be 2 charts, and I'll finish. So, nearly there. Well done, therefore. So, if I take the period 55 to 2016, I start in 55. Proper quarterly UK data kind of starts in 55, but I wanted the tail end of the immediate post-war period and rationing to work its way out of the system. So I started in 1955. Nothing changes particularly if I go a little bit further back in time. We get 245 quarters, and therefore 244 quarterly growth rates if we take that as our sample. Of those quarters, 198 were expansionary, so positive, and 46 were contractionary. The unconditional sample probability of a contractionary quarter is therefore just 46 over 244, which is a fraction of the 19%. So randomly, if I chose any quarter in the post-war period, the chance of having a negative draw is just a bit under a fifth. So that's one observation. Now, one of the definitions of a recession is that it's 2 quarters of negative or contractionary growth. There are many possibilities for recession. It could be negative year-on-year growth. It could be growth below trend. But let me just take the definition of a technical recession to make a point. The technical recession would simply be, I've had one negative quarter or quarter of contractionary growth, and the next quarter is also one involving contractionary growth. That's it. We'll take that as my definition. You could argue with it. Let's just take it and sort of run with it and see where we get to. So if these events were truly independent, we'd just multiply the unconditional probability by itself, and then we'd get the probability of a technical recession. So it's just 0.19 times 0.19, and we get just a fraction under 4%. So we'd get 4% of the time we'd be in a technical recession, if these were truly independent events. Kind of simple stats. But actually, there have been 20 two-quarter events. So something more like 10% of the time, not something like 4% of the time. So over twice as often we see these two-quarter technical recessions than we might have anticipated if they were independent. So the actual sample probability it implies is 0.189 times 0.47, that gives me the 9% number of times we've been in a technical recession. So that tells me the conditional probability of a contractionary quarter after a single random draw of a negative quarter is almost 50%. In other words, these are not independent. It's not that once you've got one negative draw, randomly the chance of another negative draw is also a fraction over 20%, so the two together are very unlikely. What it tells me is when I've had a negative draw, the chance of another negative draw in the next period is nearly 50%. That's what the data is telling you. It's telling me that the conditional probability is very high. So beware. We'll find out more about Q3 of this year in October. And if it does turn out to have been a period of contractionary growth, think on. The probability of a recession is probably nearer 50% than we might think. So recessions may, because of this, the statistics also say that recessions signal some important change. So we'll have two more charts and then some remarks, and I'll finish within 4 or 5 minutes. What I've done here is just look at the growth rates from the 7 recessions that we can observe very clearly in the post-war period. And these quarterly growth rates, T0 corresponds to the first quarter of recession, second, third, fourth, fifth, so we're going on through time to 7 quarters after the start of the recession. And what I want to simply observe, the red line is the most recent recession that we've had, and we can see that it looks like all the other recessions, mostly after 2 or 3 quarters, were almost back to zero. The negative growth rates seem to have mostly gone away. It's not entirely true, but if you look at this general swathe, the gap that you're seeing, 2 and 3 and 4 quarters, is very strongly associated with the most recent recession that we've lived through. So it looks different in growth rates. But to really understand what's going on, you have to look at the levels. So what I've done here is just normalized in the first quarter of the recession, the level of output to 100, and then followed output for the next 8 quarters. And see that the 4 recessions, 56 was relatively short, so I've stopped it after 4 quarters. Prior to 1980, just looked shallower. These shorter business cycles seem to have been associated with relatively shallow recessions. But note, each of the recessions since 1980 have been longer and deeper, where the economy has not recovered its previous level of activity even 8 quarters after the start of the recession, which I think is interesting. So why is it that here, when we had a negative draw, that somehow the economy was able to recover? Was it something to do with Bretton Woods allowing risk sharing in an open trade area with growth in a fixed exchange rate area, that we were able to export more from abroad, or demand was strong abroad that helped us come out of recession? Or is it here that the globalized world has somehow stopped that level of risk sharing, so that particularly in 2008, the whole world entered a recession together? There was no one else with who we could risk share, leading to a more persistent and deeper recession. It could be that there's a change in structure. But the 2008 does stand out as a problem for us. Recessions, I tried to convince you this evening, are shocks, surprises, and largely unanticipated. Difficult things to plan around. We can't pick peaks very well, so we can't understand when we're about to go into a recession. Forecasts will not pick them. It's a mug's game. They might be demand related, they might be supply related. They could even be policy induced. Recessions have been caused by incorrect policy from time to time as well. But yet they remain difficult to explain. It's becoming increasingly clear that they do not conform to deterministic or standard periodicity. They may be very long, they may be very short. It's very hard, actually, to know. But what they do represent, or may well represent, is a paradigm or regime shift. The early recession in the 1980s was telling us something about the need to decant from manufacturing. Could it be the recession of 2008 has been telling us to decant away from financial services? Of course, I'd never say that in the City of London and hope to get out alive. But anyway, I'm here for the moment. They clearly also imbue and scar the collective memory. As I've said in earlier lectures, the collective memory of the Great Depression from all kinds of A-level students today. I'm not quite sure how that's working, but there is a collective memory of the Great Depression. Perhaps it's good that some of them still know what the Jarrow March was all about. Recessions may have important distributional effects, and there are issues I shall consider in future lectures in this series. My concluding remarks to you, and these are the points I want you to take away. Recessions are rare but important events. Recovery can be rapid, as we saw in the immediate post-war recessions, but also quite elusive, as I think we're living through that period of elusive stability today. And so if I was to answer the question, to what extent are recessions just a negative draw? Well, sometimes it looks as though they may have been. And to what extent are they a signal for reform? Nearly always, I would maintain. To what extent is recovery the responsibility of government? Not sure. And stabilisation policy, or something for which we all simply wait? I'm not sure that's the answer either. But clearly, an ongoing recession is leaving us uncomfortable. And the referendum result as well tells us that many of us are feeling uncomfortable. Thank you very much.